Hey, good evening, fam. Good evening. Happy Thursday to everybody. Happy Thursday. Listen, so today we're going to do something a little bit differently, right? What we're going to talk about today is about really more so three things that I want us to focus on today, right? We're going to learn about the two type of life insurance because even in 2024, a lot of people don't really understand life insurance or how life insurance work. And then we're going to talk about one particular benefit, right? That not all companies have this, but a lot of my carriers actually carry this, within their policy, right? And it's a wonderful thing to have. I'm going to share a few stories about, how my clients have benefited from this package. But before we go ahead and get started, right? My name is Maxwell Akinsenwa, and I am the CEO of Titan Evolution Group. All right. So listen, there are two forms. Just to keep it simple, right? There's two forms of life insurance, right? One is called a term policy, okay? And let me put that on here so you guys can see it. Term policy, okay? That's the first type of life insurance, a term policy. Now, what is a term policy? Term policy is pretty much what we call a temporary life insurance. And the reason why we say temporary because it's not permanent, okay? You can buy a term policy for 10 years, 20 years, or 30 years, okay? Whatever your needs are, okay? Typically, most people buy this when they have a young family and they have a lot of debt. You understand? So let's say they have mortgage, let's say they have 2 or 3 children, school loan, credit card, auto loan, things like that. And they might need, for example, a few $1,000s in life insurance, right? Term policy is actually going to be the least expensive, okay, for the most amount of coverage. So it's the least expensive for the most amount of coverage, right? But again, the key word here is it is temporary, okay? I hope I spelled that correctly, right? So it does not last forever, okay? And let me give you an example as to what I mean. So let's say, for example, right, an individual, let's use a 45-year-old male, okay? Let's say that person purchased a $500,000 term for, let's say, 30 years, right? What that pretty much means is by the time this person gets to age 75, they have 2 options, because by that time the policy will be done, but you can still keep it, but it goes into what's called a annual renewable term. Annual renewable term. I'm sorry. And what that means is every single year after the 30th year, that policy will renew and the premium will go up. So for example, let's say for example, this same gentleman, 45 years old, male, 500,000 policy for, let's say, $90 a month, for example, right? Okay. Now, by the time this person gets to the age of 75, which is when the term will be over, right? If they choose to keep this policy, and this is a guesstimate here, okay? That premium will probably now go up to $350 a month for that same policy, okay? So that would be, I'm sorry, age 76. So after that first year, after that 30th year, so the 31st year, it will go up to $350. By the time this person get to age 77, it might now go to $450 a month. By the time they get to 78, it might now go to $550 a month, and on and on and on and on and on. Okay, so a lot of agents who sell these term policies, there's certain companies out there, I'm not going to name any names, who sell or preach on just buying term and investing the difference. But what they don't tell clients is after that 30th year, what happens? And people get disappointed, okay? So that's to keep it simple. That's term. Then you have permanent policy. Permanent policy. Okay? And different categories for that one. You're going to have whole life. You're going to have universal life. You're going to have index universal life, just to keep it simple, right? They call it permanent because all these will last throughout your lifetime with a fixed premium. Okay? So you buy the policy, a 45-year-old male again. Okay? 45